Salesforce.com crashed today. Should you stay in or should you get out? What happened in Salesforce today is everybody's nightmare. The nightmare of being long a strong stock. A stock that's been going up for months. A stock that's strong fundamentally, strong technically, and then out of nowhere, boom, down 20% on a gap. That sucks. My name's Chuck Whitman, and I build great traders who lead great lives. Traders I've trained have generated well in excess of $1 billion and are found at some of the top hedge funds and top trading firms in the world. I'm going to share with you today 3 secret concepts that will help you determine whether you should stay in a position or get out. And of these 3 secrets, secret number 3 is a technique that I only teach in my high-end classes. This pattern that I'm going to share with you today is a pattern that literally took me 10 years to figure out and thousands of dollars in data and backtesting. Secret number 1, understanding the impact of catalysts. What is a catalyst? A catalyst is an event in the market that makes the market reevaluate fair value very, very quickly. So it usually revolves around some type of event. My belief is that the market, 85-90% of the time, it has a flow to it of buyers and sellers. And this flow can be mapped out by using different mathematical models and so forth. But 10% of the time, there's catalysts. So Salesforce is a great example because yesterday was earnings. And earnings is a catalyst. So what a catalyst is when a catalyst comes into the market, it's going to cause a reevaluation of what fair value is. So yesterday, Salesforce missed on earnings and missed on revenue. And as a result, the stock had a reevaluation of fair value and it gapped down. So understanding catalysts are important because when we understand there's a catalyst, then we can understand the behavior that we see afterwards. So when we have a major gap down like this, it's now opening up an environment where we're going to interpret, using the other secrets I share with you today, how to be able to trade it. In this case, Salesforce opened down roughly 20%. Now, a lot of times when that happens, that's an extreme move. And a lot of times what happens is the selling, there's a puking on the open of people selling out these positions that they're getting hurt on. So a lot of times what'll happen is you'll see a stock have a major gap and then it doesn't really move. It just kind of hangs out there. We want to be evaluating, we've had this big gap down, could the stock rally back to where it came from? Will it hang out here for a while and digest this new fair value? Or is there more selling that remains in the market in which it's going to go lower? Now, secret number 2 and secret number 3 will help you actually evaluate which of those 3 scenarios are going to happen. Secret number 2, the IBP technique. IBP stands for initial balance period. And when we're stuck in a position like this, we can look at the initial balance period. Let's talk about what is an initial balance period. In stocks, there's this concept called the opening print. And with the opening print, the market maker looks at all the buy orders and all the sell orders and starts to figure out where can they open the stock where buying and selling match each other, where there's an equal number of buying and equal number of selling. So with something like Salesforce, there's lots and lots of selling. So they can see all the sell orders coming into the book. So they start moving the price down to where buy orders start to show up. And when they can find a price where buying and selling match, that is where they open the market. That is called an opening print. The opening print contains a bunch of valuable information. And this is where the new fair value is. When the market opens, we can then watch the price behavior over the next 15 minutes. This first 15 minutes, which would be like 8:30 Central Time to 8:45 Central Time, creates what we call the initial balance period. Now we watch this 15 minutes, and if the stock is able to rally above that high, and close above that high in subsequent 15-minute periods, it is telling us that there is buying coming into the market. So if we've been long and the market gaps down, we let the market open in the print, we let the first 15-minute period form, and then we start watching. And if the market's able to close above that 15-minute high, then the market's going to have a high likelihood of rallying back into the gap and starting to move back to where it came from. Now, when this happens, I'm still thinking about exiting. I don't have any hopes or ideas or illusions that the stock's gonna go make a new high. All I'm doing is trying to figure out how can I get out at a great price. But it's gonna keep me from panicking and selling on the opening. So when the stock rallies, I'm now gonna start to watch as it rallies for a place to get out. Now, if the stock breaks the 15-minute low and closes up below that low in subsequent 15-minute periods, that tells us there's more selling coming into the market. If more selling is coming into the market, we want to get out. So if we break that 15-minute low on a 15-minute close, we're going to start dumping. We're going to get out of the position and be done. This is incredibly helpful to be able to manage positions like this. Secret number 3 is called the exhaust condition. And today I'm just going to go through part of it. But essentially what happens is when we have a big gap down like this on huge volume, we're going to be on alert to see, was this an exhaust? An exhaust would mean that all the selling is done. There's no more sellers left. So if everybody's puked what they need to sell, then the market is going to go find new sellers and it's going to have to rally to find them. So we're going to watch today's bar. We're going to have a range for today. And then what we're going to do is we're going to watch in subsequent days. If the market is able to close above that high, that's going to confirm that it was an exhaust, and now it's going to open the door for the market to rally back to where it came from. So it needs to close in one of the future days above today's high to confirm that it was an exhaust. Now, if it trades below today's low and closes below today's low in subsequent days, that's going to tell us that the selling is not over, that there is more selling, and we need to get out. Because if it's able to take out the low from today, close below the low today, then there's a really strong chance that there could be a massive amount of selling coming in the days ahead. So we want to get out. Those are 3 secrets. The way to be able to analyze extreme volatility, the way to use the IBP technique, and the way to use the exhaust condition. Now, if you are a regular subscriber or you attend our workshops, you wouldn't find yourself in this position in the first place. In an upcoming video, I'm going to show you how this position could be structured differently so that if you are long Salesforce and this does happen, you would lose a fraction of the money that you would have lost today. I basically will show you how to use option structures to limit your risk and not get killed when the stock opens down 20%. So if you're interested in that, you can become a subscriber or you can watch the upcoming YouTube on this topic. And if you wanted to never be in this position in the first place, you could attend our workshops and we show you how you could look at a stock like Salesforce and see that it was already deteriorating before today even happened.